Right now. Somewhere between your last paycheck and your next one. You are standing at level 0 of investing. And most people stay stuck right here their entire lives. There are 10 levels between you and real financial freedom. Most people never even reach level 3. By the end of this video, you'll know exactly where you stand. But here's the part nobody tells you. The gap between level 4 and level 7 isn't about how much you earn. It's about one decision you're about to learn. Level 0 looks like this. Paycheck lands on Friday. Rent, car payment, groceries, a little fun money. By Wednesday it's gone, and you start counting days again. Studies on American households consistently find a huge share of people couldn't cover a $400 emergency without borrowing. Level 0 isn't rare. It's the default. At level 0, investing feels like a luxury for rich people. That belief alone is what keeps most people frozen here for 10, 20, even 30 years. Then one day, something small happens. Maybe a bonus. Maybe a friend mentions a number that makes you pause. And you climb onto level 1 almost by accident. Level 1 is the emergency fund. Just $1,000 sitting untouched in a savings account. It sounds small, but it changes how your whole brain handles money. Before that cushion existed, every flat tire or surprise bill felt like a crisis. Now it's just an inconvenience. That mental shift is worth more than the cash itself. But here's a pattern interrupt for you. What if I told you the next level isn't about saving more at all? It's about money that isn't even yours yet. Level 2 is the employer match. Many companies match a percentage of what you put into a 401k. Skip it, and you're leaving free money behind. Picture this. Your company matches 50 cents on every dollar up to a limit. That isn't a return. That's an instant 50% gain before the market even moves. Most people at level 2 still think of this money as untouchable, far-off retirement cash. But really, this is the quiet beginning of your entire investing life. Years pass at level 2 without much drama. Statements arrive. You barely look at them. And that boring patience is doing more work than you realize. Here's the twist most people miss. The real wealth gap doesn't open up at level 2. It opens at level 3, the moment you discover the taxable account. Level 3 is where you open a Roth IRA or a brokerage account. For the first time, you're choosing exactly where your money goes instead of letting it sit idle. A Roth IRA lets your money grow without future taxes eating the gains, as long as you follow the rules. It's one of the few truly free lunches in finance. At level 3, most people make their first index fund purchase. Not a single stock. Not a hot tip from a friend. Just hundreds of companies bought all at once. Historically, the broad U.S. stock market has returned an average of around 10% a year before inflation, though any single year can swing wildly above or below that. But what happens during the bad years? The first time the market drops 15% in a month, this is where most level 3 investors quietly give up. Here's the open loop I promised you earlier. The decision that separates level 4 from level 7 happens in exactly this moment of panic. We'll come back to it. For now, let's keep climbing. Level 4 is when your accounts cross the $100,000 mark for the very first time in your life. Financial writers often call this the hardest 100,000. After this point, growth and contributions start working together instead of contributions doing all the heavy lifting alone. Compound growth is quiet in the beginning and loud at the end. At level 4, you finally start to hear it whispering in the background of your statements. Quick stat for you. If that $100,000 just sits and grows at a historical average rate, it could roughly double within about a decade untouched. But doubling takes patience most people don't have. Lifestyle creep shows up right here. A nicer car, a bigger apartment, and suddenly the contributions slow down. Ask yourself something right now. Would you rather feel rich today or be wealthy in 10 years? That single trade-off decides who reaches level 5 and who doesn't. Level 5 begins around $250,000. This is where diversification stops being a textbook word and starts being something you actually feel protected by. At this stage, many investors add bonds or other assets that don't move in exactly the same direction as stocks, smoothing out the ride during rough years. Here's a pattern interrupt. Did you know the average millionaire in America didn't get there through a single lucky stock pick? Most built wealth slowly through ordinary jobs and steady saving. Research on American millionaires has repeatedly found that most are first-generation wealthy, working regular careers like teaching, engineering, or accounting, not running hedge funds. That fact should change how you see your own boring 9-to-5 job. It's not just a paycheck. It's the engine quietly funding every level you're climbing right now. Level 5 is also when people start asking a dangerous question. Should I try picking individual stocks now that I actually understand the market a little better? Some do it carefully with a small portion of their portfolio. Others go all in chasing the next big winner. Only one of those choices tends to end well. Stakes and consequences time. Picture losing 40% of your entire portfolio in a single bad bet, the kind level 5 investors sometimes make out of overconfidence. But the investors who survive level 5 aren't the ones who avoid all risk. They're the ones who size their risk so no single mistake can sink the whole ship. Around this level, many people open a separate brokerage account just for higher risk experiments, keeping their retirement money completely untouched and boring on purpose. It's a small habit, but it's the difference between an exciting hobby and an account-destroying mistake. Most people learn this lesson the expensive way instead. Now picture your accounts crossing $500,000. That's level 6. And something strange starts to happen to how you think about money itself. At $500,000, the market's average gains in a single good year can rival an entire year's salary. Your job and your portfolio start competing for first place. This is also where people first hear the term financial independence. Not retirement exactly. Just the quiet option to walk away from a bad job without panic. Many people in the financial independence community use a simple rule. If your yearly expenses are roughly 25 times your portfolio, you may have enough to step back. That rule is a rough guide, not a guarantee, since markets and personal spending both shift over time. Still, it gives people at level 6 something powerful. A target. Targets change everything about daily life. Suddenly that overpriced coffee or impulse purchase feels connected to a real number, not just an abstract idea of saving. Pattern interrupt time. What do you think separates the people who reach level 7 from the people who get stuck circling level 6 for the rest of their lives? It isn't luck. It isn't a secret stock tip. It's almost always consistency through the bad years. The exact moment we paused on back at level 3. Remember that panic moment from earlier, watching the market drop 15% in a month. The people who kept investing anyway are the ones standing at level 7 today. The ones who sold everything in fear locked in their losses permanently. The market eventually recovered, like it almost always has historically, but their money never got the chance to. That open loop is finally closed. The real divider between levels isn't intelligence or income. It's whether you kept showing up when showing up felt pointless. Quick question for you before we keep climbing. Which level do you think you're standing on right now? Tell me your number in the comments below. Level 7 starts around the $1 million mark. For most people, this is the first time investing income quietly outpaces their actual job income in a strong year. But here's something surprising. Most millionaires don't feel rich at this stage. Their net worth is mostly tied up in retirement accounts and home equity, not cash sitting around. So the daily grocery store budget barely changes. The car stays the same. From the outside, level 7 often looks identical to level 4. That's intentional, not accidental. Real estate often enters the picture here too. Some people add rental property, using consistent rent checks to diversify away from depending purely on the stock market. Rental property brings real benefits, but also real headaches. Broken water heaters and late-paying tenants don't care that your portfolio is growing nicely on paper. Some people at level 7 choose simplicity instead, sticking purely with index funds and never touching a leaky faucet at 2 in the morning ever again. There's no single right answer here. The right path is whichever one you'll actually stick with for the next 20 years without quietly burning out. Around this level, taxes become a serious strategy game. Decisions about which accounts to withdraw from first can quietly save or cost tens of thousands of dollars. This is usually when people hire their first real financial advisor or accountant, not because they're rich enough to show off, but because the math gets genuinely complicated. But here's the twist nobody warns you about. The richer the portfolio gets, the more emotional, not less emotional, every market headline starts to feel. A 2% drop on a $100,000 account is $2,000. That same 2% on $1 million account is $20,000, gone in a day. Level 7 teaches an uncomfortable lesson. More money doesn't remove fear. It just changes the size of the number attached to that fear every single time. Now picture level 8. Multiple millions across several accounts, maybe a small side business, maybe rental income, all working together like a quiet financial orchestra. At this stage, many people start exploring private business equity. Investing directly in a small company, sometimes one a friend or family member is building. This kind of investing carries real risk since private companies can fail completely, unlike a diversified index fund spread across hundreds of businesses at once. But the upside can be enormous too. Early investors in small companies that eventually grew large have sometimes turned modest checks into life-changing returns. Level 8 investors usually only risk a small slice of their total portfolio here, treating it like seasoning on a meal rather than the entire dinner itself. Pattern interrupt. Here's a number that surprises people. Even at level 8, most of these investors still drive ordinary cars and live in ordinary neighborhoods. Why? Because the habits that got them to level 1 in the first place never actually disappeared. They just got applied to bigger and bigger numbers. At level 8, conversations start shifting from how do I grow this money to how do I protect this money from lawsuits, inflation, and bad decisions. Trusts, proper insurance, and estate planning documents enter the conversation here, tools most people at level 0 have genuinely never even thought about. It's almost funny when you think about it. The same person counting pennies at level 0 is now planning how their grandchildren will inherit their wealth someday. Level 9 arrives when work becomes optional, not impossible to imagine, but genuinely optional, a choice instead of a financial requirement to survive. Many people at this stage keep working anyway, but for completely different reasons now. Purpose, mentorship, or simple enjoyment, instead of pure financial necessity. This is the level most people picture when they imagine being rich. But by the time someone actually reaches it, the daydream has quietly become something steadier. Peace. Stakes and consequences check in here too. Even at level 9, a poor spending plan can still drain a portfolio faster than the market can rebuild it. Withdrawal strategy becomes the new savings strategy. Pulling out too much too fast in the early retirement years can quietly sabotage decades of careful, disciplined work. Inflation also becomes a quiet enemy at this level. Money that buys a full cart of groceries today might only buy half a cart decades from now. That's why even level 9 investors usually keep some money growing in stocks rather than sitting completely in cash, letting growth quietly outpace rising prices. Here's a pattern interrupt worth sitting with. The hardest financial skill at every single level isn't math. It's resisting the urge to compare your progress to someone else's. Someone 2 levels behind you might have started with family money. Someone 2 levels ahead might have taken risks you'd never feel comfortable taking yourself. The only honest comparison is between you today and you a year ago. Every other comparison is just noise pretending to be useful information. We're approaching the final level now, level 10. Generational wealth. Money that doesn't just support one lifetime, but quietly shapes the lives that come after it. Very few households ever fully reach this level, and research on family wealth shows much of it doesn't even survive being passed down 2 or 3 generations. Why does wealth so often disappear by the third generation? Usually because the financial knowledge never got passed down with it. Only the money itself did. Families who succeed at level 10 usually teach their kids the same boring habits from level 1. Budgeting, patience, and discomfort with debt, starting young. Notice something interesting. The emotional reward at level 10 isn't really about the size of the number anymore. It's about the people that number can quietly support. Stakes and consequences, one last time. Without clear values attached to it, even generational wealth can quietly create entitlement instead of opportunity in the next generation. That's why the families who hold on to level 10 the longest usually talk about money openly, instead of treating it as an uncomfortable secret nobody discusses at dinner. Let's zoom back out for a second. 10 levels. $0 to generational wealth. And notice something. Every single level was unlocked by the exact same habit. Not a higher salary. Not a lucky stock pick. Just consistently putting money to work and refusing to panic when the numbers temporarily turned red. Level 0 felt impossible to escape. Level 10 feels impossible to imagine. But every level in between was just one boring, repeatable decision made over and over. Wherever you're standing right now, level 0 or level 5, the next step up isn't some massive leap. It's usually just the very next small decision. Maybe it's opening that first savings account. Maybe it's finally claiming your employer match. Maybe it's simply not selling during the next scary market dip. None of these levels require being a genius. They require being patient and being willing to look a little boring for a very long time. So here's the payoff to everything we opened up at the very start. The gap between average and exceptional was never about talent. It was always about time and patience. Out of all 10 levels we just walked through together, which one felt the most surprising to you? Drop your answer in the comments. I genuinely want to know. Wherever you are on this staircase, you're already further along than the version of you who never started. If this helped you find your level, stick around. There's more climbing ahead.